Hey friends, it's Iggy here from the Investing Iguana. Let's walk through this together. Most people chase blue chips for dividends. Safe, steady, and familiar. But here's the twist. A few mid-cap names just double down on shareholder returns. And if dividend growth matters more than a headline yield, this might change the way you build your income portfolio. Here's what we're covering today, in the same order as the Substack post. The big dividend growth story, then deep dives on PropNex, ComfortDelGro, Tongwong, and SBS Transit. After that, we'll talk risks that actually matter, and close with allocation frameworks grounded in real numbers. If you're new here, I break down Singapore investing so you don't have to stress over jargon or noise. So first up, the core idea. The market loves to crowd into the same blue chip names, but a few mid-caps have built excellent dividend track records while still growing. That's the sweet spot. Sustainable dividend growth backed by real business engines, not just a high yield from a shrinking core. Today's piece shows who's earning the right to raise dividends and how to position around that. Now, the dividend growth champions. Imagine this table for a second. The dividend analysis snapshot for 1H 2025. It basically says PropNex more than doubled its dividend. SBS Transit lifted by around 60%. Tongwong nudged up. ComfortDelGro raised too, but in a steadier way. Why should we care? Because dividend growth often signals durable earnings power. It's management saying, we can keep paying and growing. But it also hints at differences in business models. PropNex is cyclical, high growth. SBS is a steady operator with a bounce. CDG is the classic defensive. Tongwong is a niche value play. The question to ask is, which style fits the portfolio? Growth compounding, steady income, or value with catalysts? Also, a quick sanity check. These increases aren't random. They sit on top of cash generation and balance sheet discipline. If a business can't fund its dividend from free cash flow over time, it breaks. So we're always reading dividend hikes together with profits and cash. That brings us to PropNex. This is the big growth story. Revenue jumped about 73% to $599 million. Net profit surged about 122% to $42.2 million in 1H 2025. What's driving it? Project marketing commissions and a scale advantage that is hard to copy. Think of PropNex as the marketplace with the largest sales force. More agents bring more listings. More listings pull in more buyers and sellers. That loop creates momentum. Picture the financial performance snapshot table. It lines up the four names on revenue growth, profit growth, and free cash flow. PropNex is the outlier. High growth across the board. The implication is simple. Dividend growth has a real engine behind it. But here's the part I always watch. Payout. PropNex's interim dividend of 5 cents more than doubled. On paper, the payout ratio looks punchy. The offset is free cash flow, which jumped to $45 million. Management also expects a pickup in private residential activity. Still, this is a cyclical business. When property slows, commissions slow. So what's the call? For me, PropNex is a buy, but with a plan. I'd dollar cost average over a few months and size the position, knowing it's cyclical. Expect swings. If I want growth plus income, this makes sense. If I want bond-like stability, this is not that. Next up, ComfortDelGro. Think of CDG as the dividend backbone. It runs transport across 13 countries. Revenue rose about 14.4% to $2.4 billion in 1H 2025, supported by recent acquisitions like A2B and Addison Lee. That's the strategy. Expand the footprint, diversify the earnings base, get scale benefits. The dividend rose around 11%. It's less dramatic than PropNex, but more predictable. Here's how I look at CDG. It's a defensive income name, not a moonshot. The upside is its diversification and resilience. The trade-off is valuation. Solid, not screaming cheap. So my verdict lines up with the article. Hold. It works well for investors who prioritize steady dividends from a defensive operator. It's less exciting, but it quietly compounds. Now, Tongwong Corporation, this one sits in a niche. Heavy lift and haulage for O&G, petrochem, infrastructure. Revenue rose about 14% to $263.5 million in 4I 2025. But margins compressed, with gross margin falling from about 41% to 38%. Free cash flow dropped as well. The dividend still went up, which signals confidence, but this is where nuance matters. Think of Tongwong as a value play with a moat built on specialization. It benefits from regional project demand in India, Thailand, Saudi Arabia, but competition pressures margins and O&G cycles matter. When I see margins compress and FCF ease, I anchor my expectations. The article's verdict says hold, and I agree. For me, it fits a value sleeve with a long view on regional infrastructure. I'd avoid oversizing and insist on a margin of safety on entry. On to SBS Transit. The story here is mixed, but not broken. Revenue fell about 4.5% to $745.9 million after losing the Jurong West bus package. Yet the interim dividend jumped around 60% to $895. Free cash flow swung positive to $29.1 million. Rail operations have tailwinds from ridership and fare adjustments. The risk is bus tender renewal and package losses. When I translate that into an investor decision, I see SBS as a steady income component with regulated exposure. It's not purely cyclical, like property, and not as global as CDG. It sits in between, reliant on tenders and rail economics. The hold call fits. If the aim is stable yield with moderate growth, SBS can play that role. Again, position sizing matters. All right, let's talk risks the way a portfolio manager would. PropNex is tied to the property cycle and policy changes. When rates rise or cooling measures tighten, volumes suffer. ComfortDelGro took on more debt with acquisitions. Not alarming, but it reduces flexibility and adds integration risk. Tongwong faces price pressure and sector cyclicality. SBS depends on government tenders, binary by nature. Imagine a valuation and investment metrics table where you can see PE, PB, target price upside, and the simple appeal label. Growth story, dividend income, value play, steady income. That table exists to force the trade-off conversation. For example, PropNex's higher valuation reflects growth. Tongwong's lower PB reflects risk and margin pressure. As investors, we pick our poison based on goals: growth compounding, stable income, or cheap optionality. Now, the allocation question. This is where most people freeze. Let's make it simple with the same three model frameworks from the article. Growth-oriented, 40% PropNex, 35% CDG, 15% Tong, Woon, 10% SBS. Income-focused, 15% PropNex, 35% CDG, 20% Tongwong, 30% SBS, balanced, 25% each. None of these are the answer. They're starting points. The real work is matching the mix to risk tolerance and cash flow needs. If I'm using CPF or SRS, I'd bias to the balanced or income version and DCA over 6 to 12 months to smooth entry risk, especially for PropNex. By the way, if you want the reference tables in the written version, everything's on Substack. The link's just below. It has the exact numbers and the clean comparisons you can save and revisit. Here's my honest take. Dividend investing is not just about yield. It's about the engine behind the payout. In my experience, what matters most is the triangle of earnings quality, cash generation, and reinvestment discipline. If any leg weakens, the dividend gets shaky. For these four, PropNex has the growth engine but cycles hard. CDG has diversification and steady cash. Tongwong has specialization but thinner margins. SBS has regulated stability but tender risk. If I could leave you with one thing, match each stock to a job in your portfolio. Don't ask a bus operator to behave like a property marketer, or a heavy lift specialist to act like a global transport group. So, if you're planning your next move, here's what I'd keep in mind. Decide your main goal. Growth, income, or balance. Pick the allocation that fits that goal. DCA your entries. And keep an eye on the specific risk levers. Property volumes for PropNex, integration and leverage for CDG, margins and project pipeline for Tongwong, and tender outcomes for SBS. So what are you looking at this month? Drop a comment and let's learn from each other. If you want early access to deep dives, models, and the members-only Q&A, join the premium membership. It supports the channel and gets you into a serious community of Singapore investors. And if this was helpful, the next video I'd suggest is our walkthrough on building a dividend ladder using Singapore names. It connects nicely with today's allocation frameworks.